morning to everyone, and welcome to the 2026 International Research Forum on Monetary Policy. My name is Oreste Tristani, here from the European Central Bank, and I would like to thank you all for being here today, especially presenters and discussants. This is the 14th edition of the International Research Forum. The first one took place on the 5th and the 6th of July 2002. We had a proper opening speech back then by President Duisenberg, who described the conference as a new transatlantic dialogue that would bring together central bankers and academics from both sides of the Atlantic to discuss new research on theoretical and empirical aspects of monetary policy relevant to the euro area and the United States. And almost 24 years later, let me say also on behalf of the organizers, or the organizing committee, that we are proud to keep this formal dialogue, transatlantic dialogue, open. This is possible thanks to the support of the European Central Bank, the Board of Governors of the Federal Reserve System, and the Euro Area Business Cycle Network. Okay, before we get started, just a quick reminder, each presenter will have 25 minutes, discussant 10 minutes, and then there will be 10 minutes for general discussion. There is a timer in front of us, and I urge presenters and discussants to keep an eye on it. We will start to keep an eye on it, and please come to your conclusions at the latest when you see you have 1 minute left, and please stop when the timer turns red. And to all of you, so the conference is live streamed, so please get up if you want to ask a question or make a comment during the general discussion so the camera can find you, and please also wait for the microphone before speaking. So without further ado, let me turn to Matthias Meier, who will present from the University of Mannheim, who will present the first paper on the systematic origins of monetary policy shocks. And the discussant will be Daniel Lewis from the University College London. Matthias, the floor is yours.
So thanks a lot for the invitation. It's a great pleasure. This is joint work with Lukas, who will soon join Tübingen, and Klodiana, who's in the room and who will be happy to take all the difficult questions, I'm sure. So this paper is on a classical question, how to identify monetary policy shocks and their causal effects. And in the spirit of the 2002 announcement of the conference, it tries to bridge theory and empirics. It's also, maybe also in the spirit of the original conception of this conference, this is going to be a paper by Europeans on US monetary policy, so bridging the transatlantic divide. All right, so let me start with a broad motivation. Why do we care about monetary policy shocks, empirically identified monetary policy shocks? Well, they serve three purposes at least. They are used to study the effects of monetary policy on real economic activity, on inflation. Then these estimated responses are used to construct monetary policy counterfactuals, what had happened if the central bank had responded differently to a given shock. And then finally, they're also used to discipline quantitative DSGE models. For all these applications of empirically identified monetary policy shocks, we need those shocks to be well identified in the sense that they should be unpredictable and independent from other macroeconomic shocks. Okay, so now to fix some ideas about monetary policy, let me propose this stylized, serving illustrative purpose, monetary policy rule, where the central bank sets some policy instrument IT in response to a vector of inputs, xt. There can be inflation, output, many things. Now the strength of the response of monetary policy to those endogenous macroeconomic variables is the slope of the rule, a systematic monetary policy. And we allow explicitly that rule to vary over time. Okay, so that's our one deviation from the most standard way of formulating this rule. And then the WTM at the end, that's the monetary policy shock. That's what we refer to as monetary policy shock, or also intercept shock, in order to disentangle it more cleanly from slope variation. Now, a large class of empirical identification strategies used to identify monetary policy shocks, intercept shocks, implicitly assumes away any time variation in the slope. Okay, so this is a broad description of identification strategies that nest linear Taylor rule regressions. It nests linear structure VAR models used to identify monetary policy shocks. And with some qualification, I will be more precise later, it also applies to high-frequency identification. Now, the research question we ask is, can we identify intercept shocks, monetary policy shocks, and their causal effects when actually the slope is varying over time, when that implicit assumption is not satisfied? There's a related question that we think is very interesting, which is trying to understand what the causal effects of changes in the slope are. That will not be the topic of today. That's the topic of another paper that we have. Okay, so here's the one-slide summary of what we do. The paper has a theoretical contribution and an empirical contribution. On the side of theory, we consider an environment with time-varying systematic monetary policy, and within that environment, we revisit the conventional identification strategies, showing they yield monetary policy shocks that are contaminated by other macroeconomic shocks, predictable by time variation in the slope, and therefore leading to biased in impulse response functions if you use those shocks to estimate, say, the response of inflation and GDP. Empirically, we investigate the quantitative relevance of the theoretical problems we highlight, using a measure of time variation of systematic monetary policy of the slope that we've used in previous work, that ultimately goes back to Klodiana's paper. We show that we provide evidence in line with predictability, key implication of the theory, that indeed empirically identified monetary policy shocks are predictable by variation in the slope, and that when taking that predictable variation out, we find responses to monetary policy shocks that suggest a stronger, quicker, and more precisely estimated response of inflation and GDP. Okay, so this seems to make it seems to be quantitatively relevant what we identify as theoretical problems. Now, let me be very brief in the interest of time on the related literature, but just mention there is an alternative strategy to think about time variation in the slope, which is to model this as a latent variable. Think about a TVC VAR or a Markov switching DSG model. We differ in that we use measure time variation systematic monetary policy, which actually has stochastic properties which are not in line with the assumptions imposed in those other models. Okay, so that may explain what differences. Okay, let's start with the meat of the presentation. Let me start with the theoretical analysis. And the question we address here is what happens if we apply conventional identification strategies, as described 2 slides before, in an environment in which systematic monetary policy, the slope of the rule, varies over time. This is a repetition of the second slide. It shows the rule. Now we impose some normalizations on the rule and one assumption. And the one assumption is that we assume that the monetary policy shock is uncorrelated, the intercept shock is uncorrelated with time variation in the slope. Okay, so we think that's a conservative assumption that makes the identification problem not harder but easier, and that helps to conceptually disentangle those two objects. But it's an assumption we don't necessarily need to make, but I will maintain that assumption throughout the talk. Let's juxtapose that rule with conventional identification strategies. And this is a very simple univariate regression that I put down here, very stylized, yet very general. Very general in the sense that this is a description of any Taylor rule regression that you could think of, to the extent that we impose that the xt here is the same xt there. But it also describes that one equation in a monetary linear structure VAR model, which has the monetary policy shock in it. And then we'll separately discuss high frequency identification. We need to, yeah. So for the moment, for the beginning, I will focus on those two identification strategies. The first proposition makes the following statement. However you estimate the B here, whether that is estimated using linear OLS in a linear regression, whether it's estimated using external instruments, sign restrictions, Bayesian inference, whatever, for any given estimate B hat, we can show that the estimated empirical monetary policy shock contains the true shock and 2 wedges. And the 2 wedges reflect, the first one reflects sort of differences between B hat and phi. That's kind of known. This relates to the endogeneity bias. It's slightly different in this environment, but this is not so novel, the first wedge. The second wedge is the more novel element here, which really captures the nonlinearity of the rule that is not modeled by the econometrician. So the testable prediction arising from here is that some variation in empirical monetary policy shock series ETM should be predictable by interactions between time variation in the slope and whatever enters the rule, xt. At this point, should we think this is any problem? Well, I've shown you that empirical monetary policy shocks capture time variation in systematic monetary policy. this is actually consistent with descriptions in the literature, very popular descriptions in the literature. If we look at the last 2 handbook chapters of macro that discuss empirical monetary policy shocks, both of them describe prominently as a way to think about empirical monetary policy shocks, slope variation as a source. So potentially it's all fine. Okay? So the question we ask, well, is it actually fine? Can we use those empirical monetary policy shocks to identify the causal effect of intercept shocks, of the actual intercept shocks, when those empirical shock series contain that interaction, those time variation in the slope? We have a general result in the paper, but for the sake of this presentation, for a general data generating process, but for the sake of this presentation and to build intuition, it will be easiest to just walk you through a stylized New Keynesian model. Okay, so this model has pi t being the inflation rate, yt being output, it the policy rate, and then we have the intercept shock, and we have one other shock, the technology shock. We have the NKPC, the DIS, and the policy rule. And for simplicity, we assume that all the 2 shocks, but also the slope is also a shock, and all of them are IID and mutually independent. This is the simplest case we can write down, and this will be instructive. In particular, up to an approximation, we can, the equilibrium dynamics of inflation are described by the following equation, where those delta and gamma coefficients reflect the deep structural parameters of the model, where delta m captures the effect of a monetary policy shock on inflation when when the slope of the rule is at its average, when phi t tilde is 0, and then gamma m is the interaction. It's sort of how much stronger does inflation respond to the same monetary policy shock when the slope is larger than average. And then the same interpretation applies for the technology shock coefficient. Here's again here's a local projection. So suppose now you take an empirically, so suppose that inflation dynamics truly follow the first equation. And now suppose the econometrician takes the empirically identified monetary policy shocks, which in this environment looks like that, and uses it in a local projection to try to identify the effects of that empirical shock on inflation. What goes wrong? Well, we get an endogeneity bias. And the reason is that both inflation does depend on the technology shock, but then also the empirically identified monetary policy shock through that interaction also depends on the technology shock, okay? And that will bias the estimate d hat away from delta m, okay? This result is actually hard to break. One way to not have the endogeneity bias in here is either some parametric assumption where different biases magically cancel each other off. That's the knife edge case. Another one is to have monetary policy following a fully exogenous rule, which is very implausible, or assuming there is no time variation in the slope. So in general, it's hard to get rid of this identification problem. Okay, let me skip the more general results. We have another proposition for a general data generating process, some general discussion of bias. And let me jump to high frequency identification. I need to discuss this separately, but the problems are going to be very similar. So high frequency identified monetary policy shocks in a stylized way, we represent as the difference between some policy rate and the expectation of that same policy rate a short amount of time before some announcement. Let's plug in the rule, and let's assume away private central bank information effects. Okay, if we do that, then the high-frequency identified monetary policy shock contains the true shock and revisions about the slope of the rule in that narrow window around the announcement times whatever enters the rule, inflation, GDP, and so on. Now here, we have a similar type of interaction between slope and endogenous inputs, leading ultimately to, at least qualitatively, the same result, which is biased impulse response functions. There is one special case in which we can get rid of the bias, which is the case in which at every monetary announcement, T, the revision and beliefs about the slope is always the same. suppose every time the monetary policymaker makes an announcement, the public is surprised that the inflation response is 0.1 larger than expected. If it's always the same, 0.1 at all announcement, which is hard to square with rational expectations, but if that's the case, then we can regress the high-frequency identified monetary policy shock on xt and get rid of that contamination. If it's not always the same, we can regress on xt and there will still be something left. Okay, something left in terms of interaction between slope and x, which leads to endogeneity bias. Let's now move on to the empirical analysis and ask the question really whether contamination and bias are of empirical relevance. They could be theoretical curiosities that are of no empirical relevance, so it's interesting to know whether these things matter. Let's start with measurement. I briefly mentioned before that we focus on the US. So we want to think about the slope of the policy rule as reflecting the preferences of the individuals who make monetary policy. And in the US, those are the 12 members of the FOMC. And as their composition changes of those 12 members, their preferences about the rule change and the slope will change. That's the way we think about it. Now, based on Klodiana's previous work, we have a newspaper-based classification classifying almost all FOMC members as being either hawk, putting more weight on the inflation part of the mandate, or doves, putting more weight on the employment growth part of the mandate. We then aggregate that qualitative classification into an aggregate measure for a given time period about systematic monetary policy, so our preferred aggregation is arithmetic average, but our results are robust to some alternative ones. But we classify, let me also say that we translate the qualitative information into a symmetric numerical scale where +1 is a hawk and -1 a dove, and we give some less weight to swingers, so hawks that were a dove in the past or doves that were hawks in the past. And then we also consider both the full FOMC, the full 12 members, and the average hawk-dove composition among them, but also the rotation panel, which the 4 members, which are regional Fed presidents, excluding the New York Fed, which contemporaneously have voting right for a 1-year rotation and then lose it, where the idea is that the rotation panel features more exogenous type of variation. We think this is a great measure because it does not need to require us to take a stance on the policy rule, the policy instrument, and there's various validity. Let me just show you the time series. So the solid line is for the full FOMC, the hawk-dove balance. At +1, all the FOMC members would be hawks. That never happened. For the solid line, for -1, all of them would be doves. So what we see here is persistent fluctuations in the composition of hawks and doves over time. For the rotating panel, we often see these 1-year plateaus. That's the rotation. That's when the rotation changes members and the members don't change within the rotation. So our measure of systematic monetary policy is validated based on, has additional validity based on our other paper. So we show that more hawks in the FOMC predicts a stronger response of the Fed funds rate to inflation forecast. It predicts a somewhat less significant differential response to higher output forecast, but it does not predict any differences in levels. Okay, so it's really in interaction. What we find is that in interaction with inflation forecast, more hawks predict a stronger Fed funds rate response, which is really consistent with our interpretation of this measure as capturing the slope of the rule rather than the intercept of the rule. We also have evidence that it makes a difference for the propagation of government spending shocks, whether there are more or less hawks in the FOMC, but I will jump a bit over that. So let's now move on to one of the key predictions from the theory, which was predictability. In particular, we'll revisit, our main application will be the Roma 2004 AER shocks. We have additional applications in the paper, but for today I will focus on that. And we're going to revisit that through the lens of our theory and our measure of time-varying systematic monetary policy. So the Roma regression regresses intended Fed funds rate changes at an FOMC member on a range of Green Book forecasts and forecast revisions about GDP, inflation, and unemployment. Our test is taking their estimated residual, which is their empirical monetary policy shock series, and regress it on the Hawk-Duff balance interacted with X. For some flexibility, also the first difference of the Hawk-Duff balance. We also include the levels, and we also include the level. And we vary sort of the specification by including, by having lags on the right-hand side on the contemporaneous values, by varying the full Hawk-Duff balance or only the rotation panel, and also the time sample. On the next slide, I will show you a big table with a lot of R-square numbers for these regressions, for this regression across different specifications. Okay, what you can take away, I mean, the one takeaway message from the slide is that we get a lot of predictability, robustly, a lot of predictability across these different specifications. The highest predictability is for, if we take the rotation panel and allow for a 1 FOMC meeting lag in the regression. Okay, we can explain 40 to 54% of the variance in the Roma shocks through our controls. And some of that is driven by having this lag in here, but more is coming from these interactions, and almost no R squared is attributed to these level terms. Again, in line with the interpretation of this capturing slope rather than intercept. Okay, so based on that, I mean, that motivates us to construct a new monetary policy shock series, constructed to get rid of that predictability. Okay, so this is our series. Black is the original Roma series. Red, our new one. It has a much lower standard deviation, and the correlation is mildly positive. Next, we revisit the effects, impulse responses, based on those, either the original Roma shock or our new shock. So we consider as an outcome the Fed funds rate, log real GDP, and the inflation rate, and regress them on either the original Roma shock or our new shock. And our focus will be on the post-Volcker disinflation sample. We also have results for the full sample, but we focus on this sample because Ramey's handbook chapter shows that in that sample, there's not only a price puzzle, there's also to some extent an output puzzle, and the responses are very insignificant. So this sample has been shown to be problematic for the Roma shocks. Here I'm showing you the Fed funds rate response. In red to the new shock, in black to the original shock. Both of them are, for comparability, normalized to raise the Fed funds rate by 1% at peak. If we compare them, the Roma shock has more significantly raises the Fed funds rate. So if both of them are well identified, we should expect the Roma shock to have larger effects on real economic activity than our new shock. That's not what we find. Instead, we find that with the original Roma shock, there's a bit of a price puzzle, but really there's a very insignificant response of output at all horizons. In contrast, for the real GDP response to our new shock, we find a very precisely estimated, at least in comparison, response that is significant, that is faster and much larger. For inflation, we have a similar finding. There's a faster and larger response of inflation to the new shock compared to the old one. We can decompose our responses into the response to the original shock, some version of the original shock, the new shock, and sort of a contamination term, which is S. And if we look just at the contamination term, we see that it looks like an aggregate demand shock, okay, which we can actually explain through our theory. That this interactions may be correlated with an aggregate demand shock. Okay, there's one special case which is full endogeneity. If time variation in the slope could be explained by observable macroeconomic variables other than the Hawk-Duff balance, let's say GDP, inflation, and so on and so forth, then you could in principle get rid of this problem by just adding sufficiently many of those predictors of systematic monetary policy variation. And that's kind of what Aruba Drexel do, because they expand the Roma regression to thousands of regressors, not the Hawk-Duff balance. But even beyond their shocks, we still find predictability, and we still find that the IRFs make a difference. Okay, there are more results in the paper, but I have 8 seconds left, so let me just briefly conclude. So this paper makes 2 contributions. Theoretically, we show that the presence of time variation in the slope of the policy rule poses a challenge for conventional identification strategies used to identify intercept shocks and their causal effects. And then we provide empirical evidence highlighting the quantitative relevance of these challenges. And our evidence is, we hope, is also interesting per se, not only as a proof of, or as evidence of bias, but also because it provides new evidence, new insights on the transmission of monetary policy. And beyond monetary policy, time-varying rules may cause problems for identification elsewhere too. Thank you.
First, thanks a lot to the organizers for giving me the opportunity to discuss what I think was a very interesting paper. So the main argument in the paper, as you've just heard, is that the standard monetary policy shocks that we all use likely reflect systematic policy, provided that the rule is time-varying in some sense, which seems like a reasonable proposition. The problem is that this time variation then introduces some level of endogeneity, and they talk about one specific form of this potential time variation, which is the Istrefi Hawke-Dove measure. So they argue that Roma shocks and other shocks that we use tend to be predictable using interaction terms with this Hawke-Dove measure. The problem is that these terms are going to then combine this response to news or changes in the response to news with information shocks. This has some interesting relations to this booming literature on the Fed response to news, of course, and information effects. They find that purging this sort of predictability results in quicker, stronger, and more statistically significant transmission of monetary policy. I think this paper raises a lot of very interesting questions about what monetary policy shocks actually are and whether the measures that we all use are indeed valid. So they start from this simple time-varying monetary policy rule where phi t is going to capture the time variation. And they argue that when you estimate local projections, which I think is for me, the main takeaway in the paper, when you estimate local projections, there are essentially going to be 3 sources of bias. One is going to be a wedge between what you'd estimate for the time-invariant policy reaction parameter, your phi hat, and the true phi, the constant part of the reaction function, multiplied by the correlation of macro variables with the monetary policy shock, and also with the local projection error term. The second endogeneity bias coming from this term that's phi t times macro variables with the shock and the local projection error term. And then there's also attenuation bias present in these results due to measurement error. So to me, one thing that I found is that looking at these bias terms they identify is that if you include xt, the same macro variables, in your local projections, and strengthen the orthogonality of monetary policy shocks to indeed independence, you can actually eliminate potentially the first and second sources of bias here unless this term phi t xt somehow predicts current and future macro shocks, which are what's feeding into the local projection error terms. So being very clear about the relationship between phi t xt and these primitive shocks, I think would really actually be important to understand how relevant these channels of bias are going to be in practice. On the other hand, though, attenuation bias seems much harder to kill for me in these specifications, and I think is actually going to be part of their series as well because of the estimation involved. And I think this is actually best addressed with instrumental variables, which I'll come back to in a few slides. So to continue with what they argue in the paper, they're going to include these Hawke-Dove interaction terms in a Roma style regression. They're going to get this new monetary policy shock, and lo and behold, as Matthias just showed you, you get exactly what they claim, these faster responses, deeper responses, more significant responses. So for me, one of the big questions this paper raises is what we actually mean by a monetary policy shock. So some people think about this as simply being, a coin flip determining the size of an interest rate change. But I think if that's what we conceive as a monetary policy shock being, frequently we're going to find variation that's too small for identification. So for me, the sort of variation they're talking about in this paper, unpredictable or at least unpredicted by markets variation in reaction, would be fair game for monetary policy surprises if it's indeed exogenous. And I think if we think that, if the hawkishness they're measuring was predetermined and the appointment and rotation was exogenous, this might be a fair channel to look in. The issue as they identify, which I think is important though, is that in the Taylor rule, this time variation is multiplying xt, and this term taken together can behave as if endogenous, even if the reaction itself, variation in the exact reaction, was exogenous. I think the author's other paper, which Matthias mentioned very briefly, is very interesting, though, trying to exploit this exogenous variation in a clever way. So I direct all of you to take a look at that as well. My suggestion, though, given the fact that this may be a valid source of monetary policy variation, is actually not to purge the level of the Hawke measure or the change in the Hawke measure, because to me that's throwing away variation in monetary policy that actually might be crucial for identification. I don't think we can afford to be throwing away a lot of this variation. But a bigger concern here is if we truly believe that monetary policy is set via a data-dependent, data-driven Taylor rule or policy rule, if we keep adding further saturation to the right-hand side of these specifications, we're eventually going to soak up all the variation that's left in these monetary policy instruments. And then we all need to go home or come up with an entirely new way to identify monetary policy surprises. So one of the results in the paper that Matthias mentioned is the predictability of Roma and various other monetary policy series. For me, this raises a couple of questions that just, I think, require some clarification on the Hawke-Dove measure that they're using, because it really does need to be purely backward-looking to avoid potentially mechanical predictability results here. So they need to be very clear about whether there's I believe they're back now. Slides went off for a second there. Whether the persistence Matthias mentions for these Hawke-Dove measures is potentially going to cause issues in terms of mechanical predictability here, potentially reflecting simultaneous changes, observed changes in voting behavior. But more fundamentally, coming back to my point about conceptually what a monetary policy shock is, if we think that the true monetary policy shock U tau is in some way correlated with the hawkishness of the Monetary Policy Committee, then changes in the reaction function are correlated with the monetary policy shocks we're trying to measure. If that's the case, we actually cannot consistently estimate the coefficients in their regression that they're using to residualize out. In that case, the purge shock measures are going to be contaminated due to this source of bias. So it's why it's very important to be conceptually clear about what we mean about monetary policy shocks to begin with and how it's going to relate to this Hawke-Dove measure. In the interest of time, I don't I can't go into detail here on the relationship with the information effects. Suffice it to say that I think the paper is very important in that it shows the link between the central bank reaction to news and information effects, that they're essentially very hard to separate and can coexist in the same model. So I think that's something important given how booming that literature is right now. But what I want to finish with is, I think, for me, one of the more significant points here is how to use these shocks in practice. So they show that both Roma shocks and some high-frequency shocks exhibit contamination. Their solution is to purge those shocks of the predictability and simply proceed. The authors then estimate local projections using these shocks. The issue in these local projections, because they just regress on the shocks directly, is what's the scale of the responses and what's the measurement error. Of course, the natural solution here is what I'd say is now the standard use of these high-frequency shocks, just to use them as instruments in local projections with IV or S for IV instead. In a recent paper with Carol Mertens, we've developed specific tests for weak instruments for IRF estimators. Briefly, the takeaways of this paper is your first stage F statistic needs to be greater than 32.1 asymptotically. The critical values move around a little bit in finite samples. If you care about a single horizon, if you want to test jointly across multiple horizons, critical values are going to be larger. Essentially, there's a sufficient statistic for the level of variability, so it's essentially for the plausibility of a monetary policy shock being strongly identified. And that's essentially how much the forecast error variance decomposition of the policy variable with respect to the monetary policy shock. And what we find in the monthly high-frequency VAR from Gertler-Karady is that identification appears fraught, because for the instruments to be strong in this specification, you need 93% of variation in the short rate to be coming from the monetary policy shock, which is a very large number. So what happens when we take the shocks from this paper and feed them into our test? And you can see critical values depending on whether you care about output y or inflation pi. These are finite sample critical values. For the Roma and Roma shocks, the original shocks, nearly strongly identified, just a little bit short of that critical value. But for their purged shocks, you're more weakly identified because you're taking out some of this variation. But for Aroba Drexel, the original shocks, in their LP specification, we actually get very strong identification here. And we get strong identification even after purging out the predictable variation, which I found very interesting, given that in the past we've really struggled to try to find applications in shocks that were providing strong identification. For the original Miranda-Agrippino and Rico shocks, we just about get strong identification as well. But for the purged Miranda-Agrippino and Rico shocks in the paper, you get essentially zero identifying information there. But when we feed the Gertland-Karate shocks, which I mentioned we've looked at previously and found to be weak instruments, in the author's specifications, they're actually quite strong instruments. In fact, some of the strongest instruments. So why are the results so different to those in the Gertland-Karate SVAR? Is it about using a VAR versus local projections? Is it about changes in the specification? Is it about the sample? I haven't looked into all of those things, but replacing the author's use of interpolated quarterly GDP and interpolated quarterly GDP deflator with standard industrial production and CPI, indeed we find most of these specifications then start to look weakly identified again. So Aroba and Drexel shocks still look like strong instruments. Gertler-Karate shocks still look like strong instruments. But once you've purged this predictable variation that the authors pick up on, these no longer look like strong instruments. So I think this shows that the choice of specification is clearly important. It would also be important to continue looking into whether the sample period matters. For example, the authors are leaving out the GFC relative to Gertler and Karate, and also the VAR versus local projection difference clearly could matter. So for me, this paper is a fascinating contribution to a booming literature, and I think asks questions about where monetary policy shocks come from. I think we need to think about what we do and do not want them to represent and be very clear about that. There seemed to be something important in this Hawke-Dove measure, and I think that the author's local projection specifications, to me, provide surprisingly strong identification relative to others we've looked at in the literature. So maybe there's something we can learn as empirical researchers from the specifications that they've adopted.
So thank you, Daniel. Matthias, do you want to respond before we collect a few questions?
Sure. Yeah, thanks a lot for the excellent discussion. This is great. This gives us, we're currently revising the paper, so this gives us a lot of useful input to think about. We have looked at independence of shocks. That does not get us rid of the two biases that you mentioned, so we can talk more about that now, but at least we have an example where that doesn't work. Yeah, thanks a lot for the exercise involving instruments, applying your paper to instrument strength, encouraging us to look at LPIVs. This is all very well taken. It's something we should do as well. I'm less sure whether the literature has completely settled on LPIV being the right thing versus LP, but it's certainly worth looking into. What's a monetary policy shock? What's left? That's an important question. Because Ramey, Cristiano, Eichbaum, Evans, they give us a way to think about these empirical monetary policy shocks, and they have more than the slope-related way, but we take that away. So one thing is gone. There's a rounding. There are maybe preferences about intercepts that come from somewhere that may have some long-term motivation in mind, but yeah, it's an important question. And the predictability part that you mentioned, there is, of course, predictability and the Hawke-Dove balance, but you don't know the shocks of tomorrow yet, so that's important. And also, if you look at the rotation instrument, predictability beyond the rotation, it's really a different pool of. It's not today's Hawke-Dove rotation instrument is not very predictable or has basically a zero correlation, close to zero correlation with the rotation panels Hawke-Dove balance a year from now, because everyone in a year from now through the rotation, everyone will be replaced by someone else, all the 4 rotating members. I'll stop here and leave some time for questions for the audience, but I'm happy to continue.
Okay, let's collect a few questions. Bartosz here.
Yes, Bartosz Maćkowiak, ECB. So the view in the paper seems to be that these conventional shocks, Romer and Romer, are credible except for one problem. And furthermore, that you can address this problem. But a more skeptical view is that the Romer and Romer identification and similar identifications is not fully credible. It does not control for the systematic response of monetary policy to the state of the economy completely. And furthermore, that your Hogg-Dov measure also to some extent responds systematically to the state of the economy. And if both are true, then it's not a surprise the IRFs change. But I'm not sure there is a strong reason to prefer one set of IRFs to the other. And the evidence that you show on that once you add your measure, you remove predictability of these other shocks. I mean, predictability or lack of predictability is a necessary condition, but not necessary and sufficient, right? So for identifications, of course, one step ahead prediction errors from a VER are also unpredictable, but they're not structural shocks. So I think you can't really avoid a discussion of how you control for the systematic response to the state of the economy, how you model that.
Thank you. Yeah. Davide, yeah.
Yeah, so, well, I think this is a very interesting paper. If I think about the identification strategy of thinking of hawkish versus dovish central bankers, at least from a theoretical point of view, one implication should be that whenever inflation volatility is increased, say because I appoint a dovish regime, I should also see a decline in output gap volatility, because I assign more weight to output stabilization relative to inflation stabilization. Have you thought about it? Do you think it could help perhaps addressing some of the comments made by the discussant about how to think about these shocks?
Anton Nakov, ECB. One possibility for the endogeneity of your phi tilde term is that it is essentially proportional to the square of inflation, such that as inflation goes up, you want to respond more and more aggressively to the inflation, or as inflation becomes lower and lower, also you want to respond more and more, such that the Taylor rule becomes nonlinear. I wonder what would that imply for your if you had such a nonlinearity for your identified monetary policy shocks.
Okay, I see no one else. So Matthias, if you...
All right, let me start with the first set of questions. Okay, first of all, we do not claim that our Hogg-Dov balance is a full, complete measure of all the time variation in systematic monetary policy. It's something I should have maybe made explicit during my talk. But we think about that as capturing something, some variation in the slope. We also think it's likely measured with some measurement error. But still, we find that it helps to predict a lot of changes in policy and makes a big difference for the monetary policy shock. So it seems, while it's certainly not a full non-noisy measure, it seems to be doing a quite good job. Then a comment about the Hogg-Dov balance being endogenous to the state of the economy. In the other paper, we have a regression table on that. So there's most correlations with macroeconomic indicators and business cycle shocks are insignificant. Some of them are significant, much less so for the rotation panel. So if you're worried about endogeneity, of our measure of the Hogg-Duff balance, you should be much less worried about the rotation panel, and the results that I showed you on IRFs are based on the rotation panel. Then on inflation volatility versus output volatility, that's a good point. We have not looked into that. I mean, through the lens of the model, that should come out. And then the question is, how much are we not measuring? And also, well, it comes out ceteris paribus if the shock variances are unchanged. So that is already another type of variation that may not lead as cleanly to that. But it's a great comment, so we should look at that. And then finally, the comment about the endogeneity of phi potentially as a function of squared inflation rates. This is really something we address by revisiting, and I didn't spend much time on, Daniel spent some time on it, when revisiting the Aroba-Drexel exercise, because really their regressor includes inflation to the power of 2, and a lot of other, it's a very rich polynomial. And even there, we still find predictability. And intuitively, if you think about the rotation, it often leads to these one-year jumps. This is nothing that can be well replicated, even by a large range of, this is a pattern that cannot be replicated by standard macroeconomic time series. And if that pattern matters for policy, then we should expect our results to differ when we explicitly control for that, and it does. So yeah, there are no further questions. Thanks for your questions.
Very good. Thank you very much. Let's thank again Matthias and Daniel.